Silver isn't just rallying right now. Silver is flashing a physical stress signal, and the spread is screaming it while the headline price tries to play it cool. The conflict is simple. The paper market wants this to look like a fast, emotional spike, but the physical market is behaving like it's being rationed, and that's a totally different game. Stay with me because later I'm going to give you the 1 week roadmap. What level matters, what confirms the squeeze pressure, what invalidates it, and the one metric that tells you if this move is real, even when the chart looks like it, either lying. Let's start with the context nobody can wiggle out of. This week, silver printed fresh all-time highs in the mid-80s per ounce, levels that force every desk, every industrial buyer, every refiner, and every short seller to rerun their assumptions. And notice what that does psychologically. When price hits a round new regime, people stop thinking in dollars and start thinking in survival. And the shorts think survival. The manufacturers think survival. The funds think survival. And when you get that shift, the market stops being a voting machine and starts being a margin machine. But that's not the part that matters. The part that matters is how silver is behaving underneath the headline. In a normal rally, you see spot jump, you see futures follow, and you see the market breathe. In this kind of move, you see the curve distort. You see the nearby contracts get yanked higher relative to later months. You see the spread tighten like a fist. You see urgency, because urgency is what the physical market pays for. And urgency is what the futures curve reveals first. Here's the simplest way to think about it. The price is the billboard. The spread is the plumbing. The billboard can be manipulated by sentiment, by flows, by the daily news cycle, by a macro headline that hits at 9:31. The plumbing cannot fake comfort for very long. If metal is easy to source, the curve tends to pay you to wait. If metal is hard to source right now, not 6 months from now, the curve starts paying you to take it now. That's the entire meaning of backwardation in plain language. And when silver goes into deep backwardation, that's not a vibe. That's a constraint. Now, you don't have to trust a single influencer, pundit, or silver guru to understand this. You can test it with real-world friction. Physical buying accelerates in a way that feels boring at first. It doesn't start with fireworks. It starts with delivery times have slipped. It starts with premiums didn't fall even though spot pulled back. It starts with dealers are paying up for wholesale bars. It starts with the easy inventory isn't offered anymore. It starts with a strange phrase you all hear from people who actually move metal. It's there, but it's not for sale. And that's where the real pressure starts. Because silver can be abundant on paper and tight in practice at the same time. That sentence alone explains why so many people get blindsided by this market. They look at global mine supply or a giant vault total and they assume the system is flush. But the market doesn't trade on total ounces in existence. It trades on mobilizable ounces at the margin, deliverable ounces in the right form, in the right location, at the right time, with the right financing attached. And when any one of those breaks, price discovery stops being clean. It becomes lumpy, violent, gappy. Here is the hidden detail that reframes this whole story. Silver isn't and always in short. Sometimes it's stranded. The stress is not only how much silver exists, it's where the silver is sitting versus where the benchmark needs it to be. The global silver market is built on a handful of settlement hubs and bar standards. If the market is screaming for deliverable bars in one place and the metal is sitting in another place, you can't teleport it. You have to move it. And moving it is slow, expensive, paperwork heavy, and this matters, sometimes economically irrational unless the spread gets extreme enough to pay for it. That's why spreads widen. That's why backwardation appears. The ESY paper can trade one way while physical behaves like a different animal. And that's the part mainstream commentary consistently misses. So let's talk mechanics without the fog. Backwardation is when the nearby silver contract trades higher than a later contract. In a comfortable market, futures are often slightly above spot because storage and financing cost money. You pay carry, you pay insurance, you pay the opportunity cost of capital. That structure is the market saying, we've got time. Backwardation is the market saying, time is expensive, I need it now. And the moment the curve flips hard enough, it starts forcing behavior. It forces 3 types of behavior immediately. First, it encourages destocking. If you're holding metal, the market is paying you a premium to release it now. Second, it punishes anyone who is short nearby delivery because rolling a short position forward becomes painful. Your roll cost jumps. Third, it attracts arbitrage, but with a catch. Silver arbitrage is constrained by logistics and bar formats. It's not like clicking a button and shipping a file. It's metal. It has mass, it has custody, it has standards. And this is where the market structure story gets brutal. There are different categories of inventory, and most people don't realize how much that matters until it matters. Warehouses can hold a lot of silver that is eligible in the sense that it meets standards, but it might not be registered for delivery. It might be owned by someone who has no interest in delivering. It might be sitting there as collateral. It might be sitting there because moving it triggers taxes, paperwork, or operational friction. So when you see a big headline inventory number, your first question should not be, how big is it? Your first question should be, how much of it is actually deliverable under stress? Because deliverable inventory is what sets the price of urgency. And that's why, in tight moments, the market stops caring about total stock and starts caring about the part of stock that can move. Now, look at the London side, because London is the core physical settlement infrastructure for a huge portion of the global OTC silver market. The London vault system is massive, tens of thousands of tons, so people look at it and shrug. Plenty of metal. But the real question is, how much of that is mobilizable at the margin without dislocating the entire chain? London vault totals can rise while the market is still tight, because those totals tell you stock, not flow. They tell you what's sitting there at month end, not how quickly it can be redeployed when demand spikes in the wrong place. And that difference, stock versus flow, is the difference between comfort and stress. Here's a concrete anchor point. At the end of December 2025, London vaults reported roughly 27,118 tons of silver on hand. That sounds enormous, and it is enormous. It's also not a promise that every ton is available to solve a near-term delivery problem. A significant share is tied up in long-term ownership, ETF custody structures, industrial allocations, or simply held by entities that won't release it without being paid an eye-watering premium. So when price rips and spreads invert, what you're seeing is not the world ran out of silver. You're seeing the marginal ounce become expensive. You'll be seeing the market try to bribe the right holders to part with the right metal at the right time. That's what a squeeze actually is in practice, a bidding war for the marginal ounce. But here's the part that flips the entire setup. Silver is uniquely sensitive to forced flows because it messes small relative to other macro markets. And it trades like a hybrid, half precious metal narrative, half industrial input reality. When safe haven demand hits, silver moves. When industrial procurement tightens, silver moves. When a macro regime change undermines trust in the currency or the institutional framework, silver moves. And when financial flows chase momentum, silver doesn't just move, it overreacts. Because the channel is smaller and the reflexivity is higher. That's not hype, that's market microstructure. This week's catalyst stack matters. We're in early January, which is when positioning resets, mandates rebalance, and commodity indices and systematic strategies can create mechanical demand or mechanical supply that doesn't care about your narrative. Liquidity is also thinner than people admit, because a lot of big players step back when volatility explodes, widening spreads and making price jumpier. Add to that the delivery windows and roll behavior in the futures market, and you get a calendar-driven pressure cooker. The calendar is the catalyst, and most people are staring at the headline instead. Let's make this real. If you're short and the market goes into deep backwardation, your roll becomes expensive. If you're long and you are planning to roll, you might decide to hold nearby instead because the market is paying you. If you're a dealer hedging physical flows, your hedges behave differently because VOL is higher and the cost of maintaining positions increases. If you're a fund, your risk model tells you to cut or add based on volatility, not because you suddenly believe in silver. If you're an industrial buyer, you don't care about any of that. You care about supply certainty. And when those motives collide in the same week, the chart can do things that make no emotional sense. That's the entire point. This move isn't emotion, it's math. Now we need to talk about the macro layer that's lighting the fuse. Silver is being pulled by the same undertow that's pulling gold. Concerns about monetary credibility, political interference, and the durability of risk-free assumptions. When the market starts questioning the independence of institutions, it starts demanding a higher premium for holding paper promises. That's when the debasement trade goes from a niche to a stampede. And silver, because it's smaller and more volatile, often becomes the amplifier of that stampede. You just probably noticed the psychological whiplash. One day at S, rates will stay high, metals should fall, and the next day metals are ripping anyway. That's because the driver isn't just nominal rates. It is the expectation of real purchasing power and the perceived integrity of the system that issues the currency. In plain English, if people think the rules can be bent, they buy things that don't require permission. Metals don't require permission. They require custody, and that's why they react the way they do when trust gets punctured. But don't let that macro narrative trick you into ignoring the microstructure. The macro story explains why there's fuel. The microstructure explains why the fire spreads so fast. The microstructure is where the market forces hands. And when hands are forced, you get the kind of move that leaves even bullish people stunned. Let's stack evidence the way a skeptical trader would. First layer, price has moved into a regime that historically changes behavior. mid-80s and making new highs. That alone triggers risk constraints and changes hedging behavior. Second layer, the curve and spread signal urgency. Tight nearby pricing relative to later months, which is the market paying for immediacy. Third layer, physical market frictions. Premiums and delivery times that don't normalize quickly on dips, which suggests real buying, not just paper churn. Fourth layer, vault and inventory nuance. The difference between what exists and what can be mobilized under stress, especially across categories like deliverable versus non-deliverable. Fifth layer, institutional flow dynamics. ETF inflows, options activity, and mechanical strategies that amplify moves when volatility rises. And the sixth layer, the one most people ignore, global arbitrage constraints and bar format bottlenecks that slow the supply response, and even when the world has plenty of metal in total. On that fifth layer, flows, pay attention to what happened recently in silver-backed products and options activity. When implied volatility spikes in a popular silver vehicle, it doesn't just mean people are excited. It means hedging flows can become self-reinforcing. If call buying accelerates, market makers who sold those calls hedge by buying the underlying exposure. That buying can push price higher, which increases delta, which forces more hedging. That's the core of reflexivity. It's not magic, it's a mechanical loop. And in a market like silver, those loops can matter a lot more than people expect. But that's the catch. Those same mechanics can also reverse violently if the options flow flips or if the market gaps against positioning. That's why you must separate trend signal from noise. Now, on the supply chain side, here's why higher price will solve it is often wrong in the short run. Silver supply doesn't sprint. A big portion of silver production is byproduct production. Silver comes out of mining operations, whose primary economics are driven by other metals. That means you can't just turn on silver supply because silver is expensive. You can't open a new mine in a week. You can't magically expand refining capacity overnight. You can't accelerate logistics without paying for it. Recycling responds, yes, but it responds with delays and constraints. And industrial demand doesn't politely pause while supply catches up. Industrial buyers still need the metal, which means the market uses price to ration demand and to bribe supply, and in the process, volatility becomes the rationing tool. That brings us to the real-world behavior that signals acceleration beyond expectations. Procurement psychology. There's a phase where industrial buyers try to optimize price. They negotiate, they time purchases, they wait for a pullback. And then there's a phase where they switch to securing supply. That switch is invisible until it isn't. It shows up as standing orders. It shows up as we'll take what we can get. It shows up as willingness to pay up for reliable delivery. And once that switch happens, demand becomes less elastic. It doesn't vanish because price is higher. It just becomes more urgent because the cost of not having silver can exceed the cost of paying more for it. And here's a subtle but brutal point. When demand becomes urgent, it competes directly with financial holders for the same marginal ounces. Financial holders can sit on metal. Industrial users must consume metal. That is why physical stress can develop even in a world of large above-ground stocks, because those stocks are not all in the hands of people willing to sell into a scramble. The market has to convince them. The market convinces them with price. That's what you're watching now. Now, I'm going to give you a quick calculation-style intuition because it snaps the story into place. Think of the physical market as a pipeline, not a warehouse. If the pipeline normally flows smoothly, you can carry less in the pipe and still meet demand. If the pipeline gets kinked, shipping delays, bar format mismatch, location mismatch, financing constraints, you suddenly need more buffer inventory to keep the same demand satisfied. But buffer inventory is exactly what gets hoarded when people expect higher prices or fear shortages. So the pipeline kink causes hoarding, hoarding reduces float, reduced float increases spreads, spread signal urgency, urgency drives more hoarding. That's the feedback loop. And in a small market like silver, the loop can accelerate faster than most models can handle. Because if this one level breaks, the math changes. Now let's address the big objection skeptics always throw, because it's healthy skepticism. If this is real, why isn't the market already empty? Why are vault totals still big? Why isn't everyone screaming shortage? Answer, because shortages don't announce themselves with a siren. They announce themselves with price relationships and delivery behavior. The market can look fine until a specific delivery window or procurement cycle reveals the constraint. That's why the calendar matters. Certain weeks force settlement, certain weeks force rolls, certain weeks force inventory decisions, and when those weeks collide with thin liquidity and elevated volatility, price can gap in a way that feels like a discontinuity. Not because the world ended overnight, but because the structure had been tightening quietly and then it hit the wall. So what's the why now calendar trigger you should actually care about? It's the stack. Earlier repositioning, mechanical fund rebalancing, and near-term futures dynamics that can force nearby demand for hedging or delivery. This is also the kind of environment where weekends matter more because gap risk becomes real. When a market is in a squeeze-like state, you don't just wake up to a slightly different price. You can wake up to a different regime. Liquidity thins, offers vanish, and the market prints a new equilibrium before most participants can react. That's why you must respect gap risk, even if you're bullish. Now, I'm going to say something that will protect you from the emotional traps that volatility uses to extract money from retail. You can be right on the thesis and still get wrecked by the path. Silver is famous for doing that. It doesn't move like a smooth trend. It moves like a series of ambushes. It will rip, then slam, then rip again. It will make you feel stupid at the exact worst time. It will punish leverage, it will punish impatience, and it will punish anyone who confuses discomfort with invalidation. This is your psychology shield. In a move like this, the market will try to manipulate you with 3 emotions: FOMO, shame, and panic. FOMO makes you chase the top because you can't stand watching it go without you. Shame makes you hold a bad entry too long because you don't want to admit timing was wrong. Panic makes you sell a structurally sound thesis because the candle looks like a death spiral. The antidote is simple, and it's not glamorous. Define what would invalidate the thesis. Define what is merely noise and size so that volatility can't force you into decisions you'll regret. That's the whole game. So let's build the 2-scenario lens that keeps you credible and keeps you sane. Scenario 1 is the controlled pullback and retest. In this scenario, silver pulls back from the highs, maybe sharply, because profit-taking hits and volatility forces some liquidation. That's normal. The confirmation is not it goes straight up. The confirmation is that the pullback fails to break key support zones and the physical signals do not relax. The spread stays tight. The nearby premium stays stubborn. The curve stays unusually inverted, or at least less relaxed than it should be if the market is suddenly comfortable. If you see that, the pullback is not weakness. It's digestion. It's the market building a higher base before the next leg, and that's where the real pressure starts again. Scenario 2 is continuation squeeze and gap risk. In this scenario, the market doesn't give you a clean dip. It keeps pushing because the structural demand and hedging flows overwhelm available offers. You get air pockets, you get fast prints, you get headlines chasing price rather than price reacting to headlines. The confirmation here is the curve tightening further and volatility staying elevated while price refuses to mean revert. You may also see increased chatter about availability, longer delivery times, and persistent premiums despite the higher spot price. This scenario is the one that makes people do stupid things. It makes bulls over-leverage because they think the market is easy. It makes bears double down because they think the market is unfair. Both lose, because the mechanism doesn't care, it just clears. Now, what could weaken or invalidate the thesis? You need to be honest about that because trust is built on acknowledging what can go wrong. The thesis weakens if the physical tension genuinely relaxes, if spreads normalize quickly, if nearby contracts stop commanding a premium, if delivery frictions ease, and if the market starts paying you again to wait because carry returns and backwardation fades. It also weakens if macro conditions force a broad liquidation wave. Think sudden tightening of financial conditions, a spike in the dollar, or a shock that forces funds to sell everything to meet margin. In those moments, silver can drop hard even if the structural story is intact, because liquidity events override fundamentals in the short term. That's not a contradiction. That's how markets behave under stress. This is why what to watch next matters more than what you believe. Belief is cheap, the tape is expensive, so here's the near-term checklist, the dashboard you can run without needing anyone's permission. First, watch the front-month spread and the curve shape. You don't need a perfect chart, you need the relationship. Is the nearby premium staying elevated? Is the curve still inverted? Does the market still pay for immediacy? Second, watch deliverability signals. Anything that hints at tightness in deliverable inventory categories rather than just total stock. The market can be flush and total and tight and deliverable, and the second is what moves price. Third, watch physical market friction, premiums, delivery windows, and whether dips actually bring metal out or just bring buyers in. If dips are bought instantly and premiums don't relax, that's not retail hype. That's a supply response problem. Fourth, watch volatility and options behavior, because that's the accelerant. If implied volatility stays elevated and call activity remains heavy, hedging flows can keep the pressure on. If it collapses, the air can come out fast. Fifth, watch the calendar, roll windows, month-end effects, and the weeks when mechanical flows matter. Most people ignore the calendar until it ambushes them. Don't be most people. Now let ES bring it back to the core of the title. Physical buying accelerating beyond expectations. The reason that phrase matters is because it suggests demand is not merely price chasing, it's need-based, risk-based, or distrust-based. When physical buying accelerates, it changes the character of the market. It moves from speculative rally to inventory management event. And inventory management events are exactly where price discovery breaks down, because the market is no longer smoothly clearing supply and demand. It's rationing, it's auctioning urgency, it's forcing participants to reveal how badly they need the marginal ounce. If you're a skeptic of institutions, this is the clean way to talk about suppression without turning it into a cartoon conspiracy. Markets have incentives. Big players have incentives. Producers hedge. Banks intermediate. Funds chase volatility. Policymakers influence rates. Each actor responds to their own risk constraints. When the setup is comfortable, those incentives produce stable price action. When the setup is stressed, those same incentives can produce violent spikes and violent reversals. It's not a secret cabal. It's a machine under strain. And when machines strain, the weird stuff happens. Here's the punchline. In this kind of environment, the mainstream will focus on the loudest headline. Politics, rates, geopolitics, whatever gets clicks. But the signal is somewhere else. The signal is in the spread. The signal is in the curve. The signal is in whether the market can actually source metal without paying up. The signal is in whether the market can cool off without breaking structure. So let's talk levels without pretending we can forecast with fake precision. Silver is in a new regime. That means old resistance isn't a neat line anymore. In a regime like this, the most important level is not the exact top. It's just the first major consolidation zone beneath the highs, the zone where a pullback either stabilizes and builds a base or slices through and tells you the market was purely flow-driven. That's your battleground. And the way you identify it is simple. Look for where the market previously accelerated, where it left behind a gap in acceptance. Those zones become the first real tests. What confirms continuation? A pullback that holds above that consolidation zone while the spread stays tight and physical friction stays high. What confirms failure? A breakdown through that zone accompanied by a clear relaxation in term structure and a collapse in urgency signals. Not one or the other, both. Because price can break for liquidity reasons and then recover if the physical stress is real. That's why you need more than one proof point. Proof stacking is how you avoid getting fooled by noise. Now, one more warning that separates pros from casualties. Volatility will be used against you. It always is. When silver is headline hot, it becomes the perfect instrument for emotional extraction. The market will give you a breathtaking green run. Then it will slam you with a red candle that feels like betrayal. Then it will rip again without you if you panic. The move is designed by structure, by positioning, by the nature of liquidity, to punish the maximum number of people. Your job is not to predict every candle. Your job is to align with the mechanism and survive the path. So if you're watching this and thinking, okay, I get the story, but what do I do with it? Here's the disciplined answer. You don't marry a price target, you marry a process. You treat this as a structural setup with two scenarios. You respect gap risk, you avoid leverage that turns normal volatility into forced selling. You keep a checklist, curve, spreads, deliverability signals, physical friction, and calendar pressure. And you stay humble enough to admit when the market is telling you the tension is easing. Because if the tension eases, you can step back and wait. And if the tension doesn't ease, you don't need to chase. You need to be positioned in a way that doesn't get shaken up by the noise. That's the difference between being bullish and being durable. Now I'll give you the clean, what comes next for the next week or two, because this is where most people drift into vague optimism and lose the plot. Next week, watch for one of two things. Either a fast pullback that tests that first consolidation zone, or a continuation drive where the market doesn't tee us to offer you a clean entry and tries to run the stops and force capitulation. If you get the pullback, watch whether the spread relaxes. If spreads stay tight, that's bullish. If spreads normalize quickly, that's a warning. If you get continuation, watch volatility and liquidity. If liquidity thins and the market gaps, don't confuse that with safety. That's danger disguised as momentum. And for the skeptics, the ones who think every move is fake until proven otherwise, here's how you can test it without trusting anyone. Ask one question. Are the physical urgency signals aligning with the paper move? If yes, the move is harder to fade. If no, the move is more likely to be a flow spike that can unwind fast. That single question will save you more money than any influencer's prediction. If you're still here, you're not watching silver like a gambler. You're watching it like a mechanic. You're listening to the engine, not the paint job. And that identity matters, because this market rewards the people who can stay calm when others get loud. So keep your eyes on the curve, keep your expectations realistic, and remember, even if the thesis is right, silver can whip around violently on the way to resolving. The goal isn't to win a screenshot. The goal is to survive the path, understand the mechanism, and be ready when the market shows its hand. And one last subtle thing before we close. The market will try to convince you the move is over the moment it becomes uncomfortable to hold. That's the trick. That's the extraction. When you feel that urge, when you feel the emotional need to do something, pause and ask, did the mechanism change or did the candle change? Because candles change every hour. Mechanisms change far less often. Track mechanisms, and you'll stop donating your position to the volatility machine. If you want to keep building that kind of disciplined mechanics-first community, where we don't worship headlines and we don't panic on noise, stay close. Not because anyone needs a cheerleader, but because markets like this reward people who think in systems, not stories.